Hi, today I want to talk about bonds, especially their yield to maturity. Yield to maturity is the exactly the return you get. So that's the real term you get. So many people they know the bonds they do pay your coupon. They do pay your coupon. They will think bonds is a safe saving. But however, you can lose money on the bonds. Then I will show you. Okay, let's just see. This is the bonds. So, $1,000. That's is their face value. Then coupon rate, which means let's say this is annual coupon rate, which is each year they will give you 4% on the face value, which is $40. $40 on is a coupon for 3 years. This is maturity. So that's just gonna quickly to draw a timeline. 1, 2. So this is year 1, year 2, year 3. So basically this one, if you is $40, that will give you $40 every year. So you rarely can buy bonds directly. Usually you buy them on the second market because they're gonna it's just like a stocks. So they will issue by issuer, then they go through bank go to sell on the second market. So it's really they are exactly it's let's just say its par value is $1,000. So if they exactly sell at $1,000, then basically you say today I am gonna buy these bonds at $1,000. Then in the future here, this is the first scenario. This is a cash outflow, then you get a $1,000 back. So what's the yield in this situation? Your yield to maturity, your return exactly equal to your coupon rate. It's equal to 4%, right? So, but it's very rarely you can do this situation because the interest rate up and down. Once they issued these bonds, let's say once they issued these bonds, the interest rate dropped. So, if the interest rate dropped, first, it's the market interest rate went down, which means if the new bonds are coming out, so they're gonna issue at a 4%. So in this situation, these bonds will worth more. So people want to pay more for these bonds. When interest rate dropped, then you have to pay more for these bonds. Let's say you pay extra $50 for these bonds, then you still get a $40 each year, right? At the end of the year, you will get your $1,000 back. So, what is the yield to maturity in this situation? So this question become a time value of the money. So we can use the financial calculator to solve it. So basically is let's say present value is cash outflow. I paid $1,050. Then your monthly payment PMT is $40. $40 is cash inflow, right? Then how many payment is 3 payment. what's the future value? You will get your money back $1,000. In this case, we use financial calculator. We want to find out the interest rate, which is yield to maturity. It's equal to present value 1050. You have to add a negative sign in front of it because it's cash outflow. And then you have the PMT is $40. Then 3 payments. Then you have $1,000 in the future. So we can compute the Okay, I don't know what's going on. Let's do it again. So 1050 is today. You're gonna put a present value. Then your PMT is $40 PMT. Then your payment is 3 payment. Then your future is $1,000. In the future, we're gonna So yes, I think I made a mistake on the first one. So it's 2.26%. Now you can see because you pay more compared to last one, you pay more at the beginning. Even you get exactly the same thing back. So you incorporate this in all the returns. The really return you get is 2.26%. This is you can say this is less than the coupon rate, right? So this is when interest rate on the market dropped in the situation. If interest rate go up on the market, right? If the interest rate go up, let's say you can get a bonds, for 5% or 6%. So who wants 4%? The income is too low. So this bonds, when interest rate go up, these bonds will worth less than the face value. So people don't want to buy this. So unless they can buy this at a discount. So this is said the bonds is treated at a discount. So let's say you're gonna pay $950 for this. Then you still get $40 for each year. Then you at the end you'll get the $1,000 back, right? So you $40, and at the end you'll get $40. So we gonna do is exactly the same. Is the present value equal to, let's do 950, then PMT is positive $40, then N equal to 3, then the future value equal to $1,000, right? So we want to find out the yield, which is yield to maturity equal to, let's do, so 950 is selected. Hope I get everything right this time. Okay. Is then $40 is PMT, 3 is 3 payment. 1,000 in the future. I'm sorry, I need to drink some water. Okay, then we compute. Yes, is equal to 5.87%. You can see this yield is greater than, because at the beginning you pay less, then you get the same thing. You compare this, so you have a higher return on this one, right? So this is how you, this is the side, the bonds traded at the discount, this bonds traded at the premium. The people often say, oh, bonds is a safe asset, so you're never gonna lose money on the bonds. That's not true. I'm gonna show you how you're gonna lose money on the bonds. Let me find the red pen. Okay, I cannot use this one. So I'm gonna show you how you may lose money on bonds. Let's just say, you know, $1, $2, $1, $2, $3, $40, $40, $40, then $1,000, right? The reason you can lose money because if you don't hold it to maturity, let's just say in the second situation, the interest rate dropped. The interest rate dropped, so you have to pay today. So today you paid $1,050 for these bonds, right? So after 1 year, right after you received the $40, you say, I don't want these bonds, so I'm just gonna sell. But when that time, the interest rate dropped further, so nobody wants this one. So you have to sell this on the market. Let's say you have to sell at $1,000. So we don't need a calculator. We can simply to find out you paid $1,050. How much you get back? $1,040. So you have a loss $10. So that's you lost the $10 you originally your investment is, then your 10 is it $10 divided by 105. So your net loss is 0.95%. This is a loss. You lost $10. This example can tell you because the bonds is traded on the market, so you can lose money if you sell bonds, you know, at an unfavorable price. So you can lose money. So don't think you cannot lose money on the bonds. However, if you buy the bonds, you always hold it to maturity, you're more likely making money. So anyway, so that's the bonds.